Have you ever wondered how an entire country can go bankrupt? It sounds like something out of a movie, but it happened. Today, we're diving deep into the story of the Greek debt crisis, a financial meltdown that shook the world. This isn't just about numbers and charts. It's a dramatic tale of ambition, crisis, and a nation's struggle for survival. So grab your popcorn because we're about to unpack one of the biggest economic dramas of the 21st century. Let's rewind to the year 2001. Greece was on top of the world. After years of effort, it finally joined the eurozone, adopting the euro as its currency. It was a moment of immense national pride. Being part of this exclusive club meant lower interest rates and easier access to loans. Think of it like getting a premium credit card with a massive limit and a tiny interest rate. Suddenly, Greece could borrow money cheaply, and borrow it did. The government went on a spending spree, funding public sector jobs, generous pensions, and major projects, most notably the 2004 Athens Olympics. The economy was booming, people felt richer, and the future looked bright. But beneath this shiny surface, a storm was brewing. The problem was, this spending was built on borrowed money, not on real economic growth. The country was living far beyond its means. For years, Greece had been running huge budget deficits, meaning the government was spending way more than it was collecting in taxes. To cover the gap, it just kept borrowing more and more. It was like paying off one credit card with another, and then another. The national debt started to spiral. Compounding the issue was a widespread culture of tax evasion, which meant the government's income was much lower than it should have been. It was a ticking time bomb, but as long as the global economy was strong and money was cheap, nobody seemed to notice. Or perhaps they chose not to. Then, in 2008, the global financial crisis hit. It was like a tidal wave that swept across the world, and Greece was directly in its path. Banks stopped lending, investors got spooked, and the cheap money tap was turned off. Suddenly, everyone started looking very closely at Greece's finances, and what they found was shocking. In 2009, a new government came to power and revealed the truth. The country's deficit wasn't the 6% that had been reported, but a staggering 12.7% of its GDP, later revised to over 15%. The previous government had been cooking the books, hiding the true scale of the debt. It was a massive betrayal of trust. This revelation sent shockwaves through the financial markets. Investors panicked. They realized that Greece might not be able to pay back its enormous debt. As a result, the interest rate on Greek government bonds skyrocketed. Remember that premium credit card? Well, the interest rate just jumped from 2% to 20%. Greece was now trapped. It desperately needed to borrow more money just to pay the interest on its existing loans. But now, borrowing was impossibly expensive. The country was on the brink of default, a national bankruptcy. The party was officially over, and a painful hangover was about to begin. The world watched, holding its breath as the crisis threatened to not only bankrupt Greece, but also tear the entire eurozone apart. With bankruptcy looming, Greece had no choice but to ask for help. In 2010, the Troika, the European Commission, the European Central Bank, and the International Monetary Fund (IMF) stepped in with a massive rescue package. It was the first of several bailouts that would eventually total hundreds of billions of euros. But this money came with very strict conditions. Greece had to implement severe austerity measures. This meant deep cuts to government spending, slashing pensions and public sector salaries, and dramatically increasing taxes. The goal was to shrink the deficit and get the country's finances back in order. It was like a doctor prescribing a very harsh medicine to a very sick patient. The medicine might save your life, but the side effects are brutal. The impact of austerity on the Greek people was devastating. Unemployment soared, reaching over 27%, with youth unemployment hitting a catastrophic 60%. Businesses closed down, poverty rates climbed, and public services like healthcare and education were gutted. The dream of a prosperous European life turned into a daily struggle for survival for millions. The streets of Athens, once buzzing with Olympic optimism, were now filled with protests, strikes, and sometimes violent clashes with the police. There was a palpable sense of anger and despair. People felt betrayed by their own leaders and by their European partners. They were being forced to pay the price for decades of mismanagement by the political and economic elite. The crisis dragged on for years. More bailouts were needed, each one coming with even tougher austerity demands. The country's economy was stuck in a deep recession, shrinking by over 25%, a contraction worse than the Great Depression in the United States. A political firestorm erupted. Governments rose and fell. In 2015, a radical left-wing party, Syriza, swept to power on a promise to end austerity. They held a referendum where the Greek people overwhelmingly voted no to the bailout conditions. It was a defiant roar against the Troika. For a moment, it seemed like Greece might crash out of the euro, a scenario dubbed the Grexit. The tension was incredible. Banks were closed, and cash withdrawals were limited to just €60 a day. However, the reality was that leaving the euro would have been an even bigger economic catastrophe. Faced with financial collapse, the Syriza government had to perform a dramatic U-turn. Just weeks after the no vote, they were forced to accept a third bailout package with conditions that were even harsher than the ones people had just rejected. It was a humbling and painful moment for the nation, highlighting just how little power they had left. The dream of resistance was crushed by the cold, hard reality of economics. Greece had to swallow the bitter pill to stay in the eurozone. So, where is Greece today? After a decade of pain. The country finally exited the bailout programs in 2018. The economy has slowly started to grow again. Unemployment has fallen, and the nation's finances are on a much more stable footing. Tourism, a vital part of the Greek economy, has bounced back, but the scars of the crisis run deep. The national debt is still one of the highest in the world, wages are lower, and many young, educated Greeks who left the country during the crisis have not returned. The crisis was a harsh lesson for Greece and for the world about the dangers of debt, the flaws in the eurozone's design, and the immense human cost of financial crises. It's a story of how a dream can become a nightmare, but also a testament to the resilience of a nation that stared into the abyss and managed to pull itself back. And that's the incredible story of the Greek debt crisis. It's a complex and dramatic saga that changed a nation and the world. What do you think? Were the austerity measures necessary medicine or a cruel punishment? Let me know your thoughts in the comments below. If you found this video informative and interesting, please give it a thumbs up and subscribe to the channel for more deep dives into the events that shape our world. Hit that notification bell so you don't miss our next video. Thanks for watching, and I'll see you in the next one.